we're looking at clearly what's going to be the bank earnings tomorrow. We got PepsiCo this morning, but it's an overarching theme that struck out to me, in which you said that you believe there's more upside ahead as more investors realize earnings aren't as bad as estimates suggest. Why are you optimistic? I think you need to unmute there, David.
Sorry about that. We see the same issue in every downturn where there are a lot of unusual cost write-downs that get thrown in. There's a kitchen sink effect that we see where there's a huge spike going back to the financial crisis as well as the tech bubble, where companies really just kind of, when the sentiment is negative, they just go all in with the bad news. And that way the books are clear when the markets rally again. But in particular with COVID, as you were just talking about with Pepsi and as you're just talking about with the banks, we're going to see a whole bunch of unusual charges and write-downs. And those numbers cloud the picture for the normal earnings power, the underlying economic profitability of companies. And the problem is that investors are extrapolating a lot of times, not every time, but in a lot of cases, those sort of nadir level, deep level of earnings declines into the future too far. So there's a lot of noise in the numbers, as expected. There's a lot of noise in the first quarter numbers. In fact, we saw more write-downs in the first quarter of 2020 than we saw all of 2019, the whole year, and several years total annual write-downs as well. So we think it's going to be worse in the second quarter. The takeaway, Wall Street's telling you earnings are going to be down 20%. We think they're actually down on a normal recurring basis, more like mid-single digits.
David, let's forget about the one-time items for a moment, the write-downs, the one-time expenses, et cetera. What about that single-digit decline in business? Maybe that goes on for another quarter, another 2 quarters, another year, another 2 years. If we are going to see a more long-standing effect, in particular on consumer spending, because of the hit to the economy, because of coronavirus hanging around for longer than people are anticipating?
I think there's definitely some downside if this gets sort of a lot worse again before it gets better. I think there's also some pretty simple math to give you a handle on how much a stock or the market should go down if you were, for example, to lose a whole year of earnings. Let's just say earnings go to zero for an entire year. For a company in a market that on average trades at around a 20 times PE, that would mean a 5% decline, right? And then once that's behind you, you're back in business, right? So I think that oftentimes investors are overstating the impact on a lot of these companies of this short term, even if it's a full year. And if it's a couple of years, we're talking 10%, right, of zero earnings. And I don't think we're seeing zero earnings in very many cases. There are definitely some weaker companies and some that are affected a lot. But for a lot of these companies, even REITs and restaurants, they're not going to zero. They've been able to compensate with takeout and delivery, or they've been able to reopen sooner than people expected with respect to malls and stores. And so things are going to be bad. They're probably not going to be zero. But a lot of these things are going to be temporary. If it does end up going a lot longer, then yeah, I agree. There could be some more significant downside.
Hey, David, it's Julia LaRoche. I'm definitely sensing more optimism from you than pessimism, that's for sure. And if we could kind of look at some of the stock picks that you're favoring, one, for example, Simon Property Group, which, we think of them, we think of the malls. If it's not going to zero, though, like how do you kind of assess where the bottom is and where we've reached a point where it can't get any worse and there's only more upside? How do you step back and think about that from an investment perspective?
Well, first of all, I don't try to call the exact bottom. I think that's a fool's errand, right? The Market Timers Hall of Fame has almost no one in it, right? Instead, what we try to do at New Constructs in general, scrub the existing numbers, and we have some special technology that does that very well. It's actually been featured by Harvard Business School and MIT Sloan in a recent study as sort of a new paradigm for fundamental research. But more important, the valuation question, to get to your point, Juliana, is that we reverse engineer the cash flow expectations baked into stock prices. So when we first put Simon Property Group onto our focus list, the stock was trading as if its profits were never going to get back to anything higher than their 2013 or 14 profit levels. Even at a decade out, the stock was trading as if its future profits were never going to get back to where they were, close to 7 or 8 years ago. So we just feel like that's too pessimistic. I'm not trying to get cute with exactly where the bottom is or how good it's going to be or when we hit the sort of worst case of everything. What we like to look at is where expectations for future cash flows are way too low compared to what we think is realistic. And for everything that we've put on our list with sort of our see through the dip thesis, which is a bunch of stocks that we think have been overly punished by the COVID phenomenon and whose profits need only to get back to where they were in the last couple of years or close to that in order for investors to see great returns. So we like to recommend stocks whose prices imply permanent earnings destruction, permanent earnings decline that's much greater than we think is going to happen.
I would love to bring you back at some point to follow up on Simon Property Group as we get through the pandemic. But I want to also talk about a pick you have for Southwest Airlines. Tomorrow, we get the first of the big airlines earnings report. That would be Delta. No one's expecting anything great in the second quarter. But a lot of people talk about the return of flying as we go for VFR, visiting friends and relatives. And the discount carriers or the Southwests have been doing well. But now we get a COVID spike nationwide. Do you think Southwest trajectory up can sustain the current spike in COVID, or will people be afraid to fly?
I think they might be a little more afraid to fly, and I think we might, see again a little more softness in Southwest. But this goes back to my earlier point, where it's not going to go to zero, and it's not going to be forever. And as the best-in-class operator, we think Southwest is long-term going to benefit from COVID and that they're going to take market share from the firms that don't survive. They'll be around to pick up the pieces, the firms that fall apart. And if anyone can figure out how to succeed in this environment, it's the best-in-class operator, Southwest. And when we put it on the focus list, I think its profits were implying something like a permanent 50 or 60% decline. So again, we're not trying to say that these companies are going to return to profit growth over and above where they've been. We're just saying if they ever get anywhere close to where they've been in the past, you've got a lot of upside.
And one thing that the analyst at Raymond James that we like to quote a lot, Savanthi Syth, points out is that Southwest has the most cash on hand for the long term than any of the airlines. David Traynor, the new Construct CEO, we appreciate your joining us.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.